Can you please explain call and put options, long and shorts, and how different combinations serve different purposes? I found it difficult to understand. Yeah, no problem. So let me explain derivatives in general. So we all know from calculus class, and this is the only time calculus will ever come in handy for you, sort of, is that calculus deals with the rate of change, okay? And that's called a derivative. And in finance, if you just buy a stock, you just hope it goes up, that's it. It's not a derivative instrument. But in finance, you can buy a special financial product that is based on derivatives, meaning the rate of change. Which means that if you think a stock is going to go up a lot, instead of just buying the stock, you can buy what's called a call option. And that call option will help you make money if you see massive upside in that stock. And the way it works is this. I'm going to make up ideas, or make up a stock option here. Let's pretend GoPro, ticker GPRO. Let's pretend the stock is $10 right now. And you think it's going to go up to $20. And yeah, you can, buy the stock and make 100% return, or you can buy a call option for a tiny amount of money that will make you way more than 100% return. So this call option, let's say you pay 50 cents for it. And this call option is priced by somebody in the market such that if the stock goes above $13, then you start making money. A lot of money. So $7 if it goes up to 20. 20 minus 13 is 7. And all you invested was 50 cents. That's a massive return. However, it has to go above $13. Yeah, that's a strike price. Otherwise, it's worthless within a certain amount of time. Now, if the stock doesn't go up to at least $13 by the time this option is expired, all you lose is 50 cents. If it does go up to, say, $20, then you make $7 minus the 50 cents you paid for it, right? You make $6.50 on a 50-cent investment. Pretty good, huh? Now, a put option is the opposite of what I just said, okay? A call option is what I just told you. You make money if it goes up. A put option is you make money if the stock goes down, okay? It's the opposite of everything I just said. Now, a long and a short are different. A long means you just buy the stock. A short means you just bet against the stock. You're betting it's going down. That's it. And with a short, if the stock goes up to infinity, you lose everything. With a put, if the stock goes up, you just lose that 50 cents. That's it. It's not that bad. Now, why would you use a call and a put together? The reason you might use a call and a put together is if you're making a bet that a stock is not going to move that much in the near term. And you might want to do that because you own a lot of that stock or whatever reason outside the scope of this example. And so you will buy what's called a straddle, and a professional money manager will create it for you. Okay. Don't do this yourself. And a straddle basically is an instrument where you own some calls and some puts. And if the stock goes up a lot, you lose this. Stock goes down a lot, you lose this, or vice versa. If it just stays as is, you might make money on both spreads. Okay, I know it sounds a little bit complicated, but that's what option strategists do. And a lot of people use options that rely on commodities. So Southwest Airline, ticker LUV, which is the coolest ticker ever. That's Lovejoy Field, which is their headquarters, I think, in Texas, What Southwest Airlines did brilliantly, and it was predatory, was, I think it was 15 years ago or whatever, maybe a little bit longer than that. They bought special financial instruments that set the price of oil at $30. So they bought oil into the future at $30 a barrel for years. And then oil went up to $100 a barrel. And what happened was a lot of other airlines went belly up or almost went bankrupt. And Southwest cut prices. Predatory. Because they could do that. Because they were hedged in. So that's another example of using options. So yeah, hopefully that's helpful.